than the realized volatility. That's when they're really going to make up their money. So
Right.
here they haven't made it up. I don't think they have made it because everything I think was fairly priced, even though volatility was high. The realized volatility did match it, and so
Hmm.
they haven't made up that much of their money yet.
Right. Yeah. So do you, if you have the chart up right there, do you see what I'm saying about like potential broadening pattern? If you take that
Yep.
that low from like the 23rd and then connect it to the low in the 10th, it's like you have slightly lower lows, then you connect the recent highs. Um, so
23rd.
no, so I'm looking at a broadening pattern like an
Oh,
alligator's mouth.
yeah, yeah. So you're going like this.
Yeah. So if you take the previous, yeah, just yeah, exactly. So something like that, where if you drag those lines a little bit back, you kind of connect the lows, connect the highs. That's
Mhm.
possibly what I could see happening over these next couple of weeks. I know we have earnings season, big earnings this week on Tesla, Intel. I actually took a few trades. I think we did 4 positions today in newsbreakers, and we're doing classes on Monday, Tuesday, and Wednesday for trading sessions. So we have 4 trades in today. Um, I did not take a live trade for waterfall, which is really unusual, but I'm like the premiums that I usually get on like a mechanical basis were just not there today. The trades I typically take where I'm looking for like 50 cents or 60 cents, it was trading for like 30 cents. I'm
Mhm.
not gonna force that trade and take less credit.
Yep.
And then on the flip side, I actually looked at doing a call condor, which is a fancy trade for like I do a bull call spread that would be a profit trap, and then I do a bear call spread above that that's a little bit wider. Even those premiums were just not good. I was getting like 40 to 50 cents. And I was the prices just didn't match what I was looking for. And so
Yeah.
I said, all right, look, I'm gonna do a couple of pending orders. This gives us a credit we're happy with, and the mechanics we're happy with. This also gives us a I went right back down to the low on the 10th, and I just did a bull call spread at the low at the pending order. I still am like so angry that the market dropped the 10th the way that it did. And if you did not get right in at the end of the day on Friday, you wouldn't have made a
Yep.
single dollar, that
Yep.
following week. So it
Yep.
just felt really slippery last week. That's all.
Yeah. Yeah. It definitely did not give many opportunities. And what you're saying is that even though the volatility is elevated right now, you're not getting the credit that you need in order for it to
Right.
make sense for you to put on a trade. And that's a function of the actual realized volatility is actually up there also. It's not just the implied volatility.
Yep. I did sell some premium last week. I mean, when the VIX was up to, I mean, what was tradable VIX for me was like 24.25. It basically, I think it was like Thursday to Friday's gap was like 29, and it just faded all day Friday. But I did sell some. I did some 1-1-1s or like kind of a ratio spread combo on SPY and Qs. I collected like 250. I think I've got a couple trades in here. I'll read them off. You can keep the screen. I'll go through my pinch or my project options edge. So
Okay.
I did a trade on QQQ for $1.19, SPY for $1.65, Qs for $1.18, SPY for $1.30. So between those 4 trades, those are, by the way, those are all the way back to April lows with a profit trap. So $1.30, $1.65, $1.19, $1.16, $530 worth of credit with about a 98% chance profit. I'll take that. I mean, that's one thing I typically do when the VIX is elevated is I go way out of the money and I sell some premium, and there's another $500 by the end. That was only out to like
Yep.
December 31st, so I didn't have to go out super long. I think the market will. I'm hoping the market will hold those April lows by December.
Yeah.
So
Okay.
I
It
think
looks
that'd
like
be
we
a,
got
a
a
huge
couple
crash.
questions here. Donna, good day to you. Jack, do you have a recording of last Monday's showing? Deanna, if you're there, if you could throw up a recording or the link to the recording, that'd be
Mhm.
great.
Yeah, I'll get that.
Great, thank
Perfect.
you. And Dr. KD, I want to move my money from E-Trade because they charge that much. They charge $25 per trade. That's crazy. Um, Unfortunately, TradingView has to be hooked up to a brokerage. So you'll need a separate brokerage to move your money to. You can't just use TradingView as your broker.
I feel like Dr. Katie is not in the U.S. That
That
seems a
must be
little
it.
that seems a little
Yeah,
excessive for
that
an E-Trade
is real.
$25
Yeah.
commission. I feel like is that are you in Canada by chance? I know like Quest Trade, Interactive Brokers, some of the I was gonna say some of those like I don't tell Dr. Katie where you from or where you at right now. No, that's what they told me. Are you a US
Uh,
trader? There's
yeah.
there's no way they can charge that much for a trade per trade. Their commissions are probably gonna be like $1 or $2 for an option contract. Yeah. Rates and fees. I would guess they're somewhere between, a dollar.
Yeah. Zero for stock and options. Contracts, 65 cents per
So yeah,
quarter.
you got a round trip at a dollar
Or
30,
yeah.
right?
Yeah. Unless you do more than 30 trades a quarter, then it's 50. So you round trip at a dollar.
Yeah,
That's more in
which
line
again,
with what you
that's
see with
pretty
most
good.
brokers. Yeah.
Maybe the guy didn't want to help me. Well, it's fun. I don't know why he's even working there if that's the
I
type
don't
of
know.
help you're going to get.
Yeah. It's
Yeah.
been
All right. Well, thanks for everyone else popping up too, saying like that's not each. So, like I said, I've known traders that are not in the U.S. Like Canadian traders have pretty limited broker options. I mean, I'm pretty close to the team at Tasty Trade, and I know that they have gone back and forth for like the last year with Canada trying to get
yeah.
Canadian permission, but they just haven't been able to. So Tasty Trade is not available in Canada, but they're all over the world elsewhere. But I know in Canada, like Quest Trade, Interactive Brokers, that's
Right.
I'm not saying that's the only options, but they are very expensive. We had like limited broker options, so just sounded like with that type of charge, I feel like that was maybe a Canada broker. But
Yep.
anyway, we know the deal. So all right, Kane, I want you to have as much time as you need today. What type of like trade showcase strategy did you want to go in today for the GAM report? We talked a lot about the
Yeah.
collar trade last week. I did do a full-fledged collar trade on SLV last week. I bought the shares. I did do a stagger where I went out higher on the call side and I went longer in time, but I did buy a put out to the end of the year. So I did SLV. I bought the shares. I bought a put at the money out to the end of the year to December. And then I went out to March and I sold my calls at a higher strike. So I financed the trade for like 15 or 20 cents. I have $5 or $6 of upside appreciation, but I have immediate protection in case we get I'm again, if I'm wrong and gold and silver just do not stop going up, it is going to be one of the wildest things of 2025. I think this might be the bigger story than like Liberation Day drama. It's like the fact that gold and silver have just not stopped. But we
Yeah.
don't know. We don't know yet. I think there's going to be a technical correction. I'm hopeful that there will be because I want to buy some dips. But anyway, I did a collar trade last week. So if you're in the session, we spent some time in that collar trade. I executed that. Uh, I think I'm trying to think when I did that. I did the trade for Project Options Edge. That's a service that I ran it in. I'm doing a campaign trade in SLV. SLV is silver. It's a lot cheaper than trading gold right now. But that's a good way to start and still have some exposure. Meanwhile, have immediate downside protection. So I want to turn it over to Kane this week and let him run with one of his favorite strategies, something that can help just broad-based education, but also if he's got anything that he's liking that's actionable, then let's get into that today.
Yeah. So for sure, if you guys want to go back and see Chris's collar trade, Diana did post a link. Actually, looks like she didn't post to everyone. Let me go ahead and do that. So I'll send that out to everyone, and you guys will be able to check that out. And so this week, I thought I'd go over a trade that, or at least a structure that I love a lot. And one of the reasons why I love it is that it is appropriate, or at least you can modify it for just about any market environment, including a high volatility environment like we're in right now. And that structure is a butterfly. So, how many of you guys have heard of a butterfly before? How many of you guys have traded a butterfly before?
Regular butterfly or broken wing?
Let's just start with a regular.
Okay.
Probably more
Okay.
people have done a regular than a broker wing. But
Yeah,
or
sure.
yeah, yeah. So one, two people say yes. Rangeley, no. You may yes. So actually, a lot of people have traded butterflies. That's interesting. Okay. So most of you, it seems like, are reasonably familiar with the butterfly. And so this might be pretty easy. But if you have any questions, just let me know along the way and will go through yes with me. Okay. Then you know that I like to trade butterflies quite a bit. So there's a couple
Mhm.
butterflies here. If we go, there's the iron butterfly, there's a long put butterfly, the long call butterfly. And what's really interesting is it doesn't really matter too much if you express your viewpoint in terms of all puts, all calls, or a combination of put and calls. The combination would be the iron butterfly, and then obviously a long put or a long call the would just be all puts or all calls. Now, generally, if you're going to use all puts, you would have a target that is lower than the current price. And if you're going to do all calls, then you would have a target that's above your current price. But it doesn't have to be the case because of the fact that in a butterfly, you're buying and selling at the same time. It actually doesn't really matter too much if you're doing the puts and calls. I'm going to use an iron butterfly just to get us started. And yeah, I might as well do the example on SPX. And later on, I'm going to ask you guys if you have something that you want to trade or that something that you're looking at, and we can build a trade around it potentially. All right. So let's take a look at this. Why butterfly? Well, the number one reason is that, or at least I should say the first reason, not necessarily the number one reason. There's actually a few reasons that I like better than this first reason, is that if I do a butterfly, let's go out, you know what, let's do SPY just because it'll be a little bit easier. I won't have to move things so far out. So if I just stick with this, a 5 wide butterfly, so I'm selling a 672 put because the market's currently right at 672, and I sell a 672 call. And then, so notice I'm selling this same strikes right here. And then I go 5 wide. I sell the 667 put and I buy I buy the 667 put and I buy the 677 put. That creates this butterfly structure. And right now, when you take a look at it, it looks not so great because we could have a maximum of $90 of profit right here and a max loss of 410. What was really interesting is that if we saw this volatility the way it was last week, this would have been more like 150 to $200. It was almost a 1-to-1 for a 5 wide butterfly. So that's one reason why I really like it during volatile times when the IV is really high, because you can get some really, really good reward risk ratios here. And you still can, even in a low implied volatility environment, you just have to play around with this a little bit. So the first feature that we see here is the theta. Theta is positive over here. And what that means is that over time, as time goes by, this P&L curve is moving upwards. Maybe I should zoom in on that curve a little bit. Okay. So as time goes by, you're making money. Unlike a single option where you would be losing money if the price didn't move at all, then you're actually making money. As long as you stay within the profit range, you're going to make money. Now that might sound familiar if you know about iron condors. And so iron condor is very similar, except you don't sell the same prices. And when we go over here, if I go like this, if I keep the buy strikes the same and I go 1 wide over here on the sell strikes, what you see is I get this very flat iron condor. And this one's even more terrible because my profit potential is $1 and my max loss is 99. That's a 1 to 99 reward risk ratio. So I have this wide range of possibilities where I could make money, but if it busts out of there, I'm losing 99 times my money. Okay? But if I go to the iron condor, the iron butterfly, what's happening is I'm selling two at the money options. And the at the money options are always the ones with the most premium baked into them. Then they're the most popular ones also. Most people, if they trade the at the money. And so the most premium is baked into there, and you get the most money if you're selling premium at the money. And so you get a much better reward risk ratio if you do this. So if this was 87 to 413, so that's shifted a little, but let's do the exact math over here. Okay, so that's a 1 to 5, 1 to 5 reward risk ratio versus 1 to 99. And what we'll see here is that if I do this break even analysis, where does the break even happen versus the Iron Condor? The break even on the Iron Condor was basically 668 and 676. Okay, so basically, because we only got $1 for this, it's exactly basically where we sold our strikes. And over here on the 672, if I do both 672, this is 671 and 672.86. Very similar, but just to make it apples to apples comparison, I'm going to look for the Iron Condor that gives me break evens at 671 and 673. Okay, so let's try that if we can even find it, because the prices are so crazy right now. So that's pretty close, 671, 673. Okay. And what we're seeing here is that that's at 15 divided by 18. Okay. And that's about, actually, it's a little bit better than Iron Condor, which is pretty unusual. So it's about a 4 to 1. So today's pricing is really weird. Oh, I'm doing zero DTE. Let's bring out the expiration. It'll make this a lot easier. Let's go out to November 21st expiration. Okay. So let's do that again. Apologize for not looking at the expiration earlier. If we look at this, okay, here we go. So this is the relationship we expect. Zero TT, obviously the credits are, or the time value is crushing very rapidly. So if you'll see it a lot better if we go out a week or a month. And so if we do a month, this 5 wide Iron Condor, you can see is paying really, really well. Really well. It's 470 versus a $30 loss. So that is a 15.6 to 1 reward risk ratio. It's really hard to find that type of reward risk ratio anywhere outside of a butterfly. It's going to be very, very difficult for you to find anything like that. So the break evens here are 667.3 and 676.7. So 667.3 and 676. Okay, so that's pretty close. And if I look at the return on this Iron Condor, it is 87.5 divided by 12.5. Still really good at 7 to 1 reward risk ratio, but that butterfly was more than double. It was 15.6 to 1 reward risk ratio. So we get this really great reward risk ratio. And then you go, Kane, well, the shape of this is different, right? This has a flat top. I have a really wide region where I'm guaranteed the same amount of profit, but the butterfly was this triangle. So I don't get that same guarantee. At some wing out here, you're going to make less on that butterfly. And that is true. So let's compare remember I was getting 1250 all the way across the board, or a 7-to-1 reward risk ratio. If I go back here to my iron butterfly, at what point do I get the 7-to-1? So 7 times this 30 would be 210. I'm looking for 210 over here. So between the range of right here, this is 669, all the way up to right here, which is 675, I'm getting at least as much profit as that equivalent or the same break-even iron condor. And so what you'll notice is that the range in which the iron condor would give the same $210 if we put the same amount of investment into it is only just barely wider than this butterfly. And the break-even range over here was, we chose them to be the same. So what that means is that there's a lot more profit baked into this kind of the top of the pyramid. And that so that if we land in that narrow range, you're going to get a much better return than iron condor. And on average, in between the break-even points, there is more profit baked into that iron condor. So even if we end up at the fringe over here, that's the only place, like we're not in the max loss zone, or we're not break even. We're doing a little bit better than break even. This region in which where you would make less money than the iron condor is very small. And so the chances of you actually doing better than the iron condor is very high in the butterfly. Okay. Is the session recorded? Yes, it will be recorded and the recording will be available. So that's another reason for the butterfly. You get really great reward risk ratios, which gives you really wide break evens. And that theta decay means that you get to enjoy this, the passage of time. You're not worried about the passage of time. Even if the price isn't moving anywhere, you're getting benefit from that. So one thing that comes out of this that is really, really good, and I think, Chris, you'll appreciate this point a lot, is what we call the T0 line. You know what? I should keep that comparison available for us to the iron condor. If this will go. We'll let that load up. So what we're seeing here right now is it's hard to tell, but at T0, when I put on the trade, you see how that green line is a little bit above the 0 line? When I first put on the trade, if there's movement, I'm making some money. I wish I could zoom in on option strat. You know how to do that, Chris? I don't think they'd let you do that.
Only the range. It just cycle the
Only the
range.
range, yeah.
Yeah. Yep.
Okay. So if you look right here, okay, I'm going to move the date out just to demonstrate it a little bit. So just say I move it out to here, okay? And just pretend I didn't move that date range, that we're zoomed in really far. What you would see is that instead of this line right here, when I first put on the trade, I should have 0 profit on it. But the moment a little bit of time passes, it's going to go above that 0. And what you see is that there's this really wide range that is far beyond the expiration break-even point where I can make money. You see that? The normal break-even point was over here at 667, but all the way up until 1 week before expiration on Friday, I could be way down here at 656 and still have a profit. I could be at 654 and still have a profit. I can be at all the way, my break even points all the way at just below 653. And over here on the upside, my break even is at 686, 687. So that gives me, so even though my expiration break even is at 667, 676, my 1 week to expiration break even is $10, actually longer, $15 wider on the downside. And right here, we've got $10 wider on the upside. So it makes it really hard to lose money all the way up until pretty close to expiration. So it's a really great trade for beginners because it's hard to lose. And in fact, you can adopt the strategy that I'm never going to hold to expiration. I'm going to hold until 1 week or 2 weeks before expiration. I'm never going to hit that 470 to 30. I'm never going to hit the 15 to 1 reward risk ratio. But right here, this profit right here is 10%. Okay. So I can hit anywhere from 0 to 10% in those first weeks of the trade and have a really, really safe trade. Because who thinks that in the next 3 weeks that we're going to be beyond 686 or below 650? Even with the current volatility in the market, that is just extremely, extremely unlikely. So that's one reason why I really love butterflies, because you have this really, really forgiving T0 line that even as we go up the expiration and get pretty close to expiration, it's still really wide. You see, let's go 1 day remaining. Okay. If you hold up to the last 24 hours of this trade, look how far out that break even is versus the expiration break even. And so what that does is it gives you a lot of time to react and respond. If you say, "Oh my gosh, I'm well out of the break even range," I can still take a baby profit and not really have to worry about it. It's only T0 where I have to scramble. Oh my gosh, are we close to break even? Are we in the middle? How much range do I have to go? And so it's a really, really great trade, not only for beginners, but for anyone who's worried about managing their risk. It makes it super easy. You never have to rush. You never have to panic. And if you always manage, if you say, "Hey, I'm just going to avoid that last day or the last few days completely," then you can be super relaxed about the trade. Right. So this is probably my favorite reason for butterflies. Now, on the flip side, if you're more profit oriented and you're like, "Kane, I could have gotten a 15 to 1 reward risk ratio if I pinned it. And even if I don't pin it, there's a reasonably large range where I could get at least 100% on this trade." Then why is it? It's going out the credits. That's why the percentages are messed up. It's showing 100% at the peak. Expiration, which is not the case, right? Your reward, you always want to calculate it off of your invested capital. And your invested capital here is actually, yeah, it's the $30 right here. So we're going to have to calculate that ourselves. Basically, we're looking for
It's like a 16 to 1,
$60.
right?
Yeah, it's a 16 to 1.
Yeah.
So look how
Yeah.
far out, $60. I mean, anywhere between 668 and 676 is at least a 100% winner. So if you're happy with this range, this $5, if you think you can peg it within $5 of expiration, I know I went a little far out but if you did this at a earlier expiration, then yeah, you could get really good reward risk ratios right here. For very little risk, you get into a nice solid trade that is really easy to manage, and only up until the last few days, or maybe even the last day to expiration, this is really where I have to worry about the price getting outside of this range. And if I do an okay job, if I can peg it within $4 instead of $5, then I can still make a 100% return or better. And if I happen to nail it on the dot, then that's almost a 16 to 1, as Chris said. Okay. So, um, so I have something wrong. Looks like a 988 debit. It shouldn't be a debit. If you're doing the iron butterfly, it shouldn't be a debit ever. So if you got a debit, then what would happen is that you have a risk-free trade. And so basically, whatever your debit was, here, let's see if I can do that. Okay, I just made that a debit. Okay, a $9 debit is, sorry. Oh no, if you made a debit, if you made it a debit, then you're a guaranteed loser, actually. It'd be a completely red. I just said that backwards. So sorry. Uh, and then there are tricks like this. So Chris talked about legging into his credits, his his callbacks. Was it your callback ratios, or was it the what was it? I think last week you talked
I
about.
legging into, so one of my favorite things is if I leg into like credit spreads, I will just stagger credit spreads over like what I
Right.
think is going to be pretty good resistance level. So I'll do typically like a five wide, five wide, five wide. Um, the butterfly stuff, I teach butterflies quite a bit in my double up service. Reason why is this is all I like to focus on. And I typically go out like 0 to 1 day. I don't like to go more than that. I say
Mhm.
it this way: butterflies are amazing. And the reason why is there is not a strategy that options offers with the consistency of a high reward to risk setup
Yep.
than a butterfly.
Yep.
So even if you are wrong, this is probably the easiest strategy to embrace being wrong because it's such a tiny little debit.
Yep.
And as you said, so Kane, how often, if you take these trades, how often are you holding to expiration?
Never.
Same.
Never.
Like
Nope.
I try to tell people, like, if you're trying to hold this thing to pin price and you're going after that 16 to 1, here's what's nice about the butterfly that Kane's expressing. This 16 to 1 setup can easily offer 1 to 1, 1.5 to 1, 2 to 1, 3 to 1 within way before expiration. It can offer it within, you don't have to hold it all the way to the profit trap. You can get this days before expiration. And I think that is the safest way to trade these is if you think about it this
Yep.
way, every butterfly you take, if they offer 10 to 1, offer 9 to 1, offer 15 to 1, that's amazing for getting lucky on the pin. Because if you think about this trade, this expiration is November 21st. The odds of going out over a month and pinning this thing at 672 in the next 20, I guess 32 days, that the probability of doing that is very, very difficult. So
Yep.
that's not really the trade. The trade is you give yourself a wide margin for error. You basically cast a net out in the market that, as Kane showed with that like wider left and wider right side, those two tails, you can have prices within 10, 12, $15 and still have a break even or better. And then once you're getting in some profit opportunities, if that $30 debit that you, or the $30 max risk is the most you can lose, I mean, if you're generating $30 of profit, that is a 1 to 1 reward to risk. If you're generating $60 to $90 of profit, that is a 200 to 300% reward to risk. And obviously 1,600% is incredible, but it's just not the probability. So if I like the trade, I mean, like I said, my double up service, I usually, if I can get wins in the 125 to 200%, I take those trades all the time,
Yep.
because they can get hit. Like making 200% a butterfly in a 0 day is pretty straightforward. In a 1 day, it's pretty straightforward. I do like how much forgiveness you have going out longer. I honestly, I feel like after spending time with you, Kane, I want to spend more time on like what would be like a 14-day butterfly, what would be a 30-day butterfly,
Yep.
just to give myself that wider net and also give myself that time flexibility which again, for such a low risk trade, it's so nice to have that peace of mind that this market can be crazy and haywire, but you have a big net that you're still going to get paid on and your risk is minimal. And when the market is topsy-turvy, ups and downs, it can be all sorts of wild things. You just give yourself a lot of risk management and the ability to make 1-to-1, 2-to-1, 3-to-1 way before expiration. It also feels pretty good that my return on risk is higher. And so statistically, Kane, what do you think on a strategy like this? Would you ideally shoot for like a, if you can win, let's say 150% or 200%, and you could still win like 55 or 60% of those trades? Would you think that would be like a good setup as far as like how often you want to take these type of trades or what you're looking for results?
So that'd be great. That'd be
Yeah.
great. So,
Yeah.
but I mean, I probably win uh, close to 80% of these.
That's
So,
awesome.
so
Even
yeah, so
better. And
yeah, even better,
with the
right?
80%, are you typically getting a greater than 1-to-1 as far as like reward to risk?
Yeah, yeah, for sure.
Okay.
And so
That's
what
awesome.
I'm looking for, I'm generally looking at a 125 to 200% is what I'm looking at.
That's awesome. Yeah.
Yeah. And so
Very good.
there's a
I
couple ways to manage it because we do have all this time on our side, but the other point is I picked if you're going to go directional with these things, then I wouldn't be
mhm.
doing the iron butterfly. So let's just say I was long, I don't know, long Tesla, okay?
Okay.
And if we go this to Tesla, oh, still loading. Sorry, my internet is limited to the hotel. So, no, but if you're long Tesla and you think that it could go another, maybe I can shortcut this. Just say you think it could run up $20 in the next 3 weeks, and then you do a long call. Maybe you can do this, Chris. I think.
Yeah,
Uh,
I had the same thing happen, dude. I was actually
yeah.
taking a calendar spread trade, and I just got timed out myself. So
Oh, okay.
I'm yeah,
All right.
I don't know what
I
happened to
got you. It
their
must be option strat then.
yeah,
Uh,
like clear the
So,
cache. It's doing the same thing. I had it like 3 times, buffer
okay.
and not give me the website.
Yeah. So the option. So if we think Tesla is going to go up, say $20, and it can happen in 3 weeks, and
Let me do
so
this, Kane. I'll build it out. It won't be the same mechanics, but let me build this thing out. I'll show you the screen here. I'll build it out in my dynamic trend. Give me a sec.
oh yeah, that'd be great. Thank
Okay.
you.
All right. Cool.
Yep.
So I'll float this out. Dock this. There we go. All right. So just give me the mechanics of the trade. We're going
Okay. So
SPY or SPX or Tesla. You said
let's do Tesla. Yeah.
Tesla. Okay. Can you see my screen, everybody? Can you good?
Yeah, I can see it.
Okay. Okay. Let's build this thing out.
All right. So let me bring up a chart so I can see where Tesla is right now.
Okay. Is this another iron butterfly?
This is going to be a long call butterfly.
Long call. So only 3 legs.
Yep.
Okay. And we're going to sell the guts.
Yeah.
Yeah. Okay.
So we're going to sell where we think the target is. So $20 up
Yep.
from here, just say 475. So sell 475.
Okay.
Okay. And what I will do is I like to have my lower break-even point close to or a little bit lower than the current price. So I'm going
Okay.
to a really wide butterfly here. Okay.
Okay. You want to do like
So
440, 435? How much lower?
let's do 440. Let's try
440.
440.
Okay.
So we got a 35 wide on each side. So that's going to be 510.
510. Yep.
So that's huge. Look, that is
Yeah.
so wide. That is
Yep.
so wide, but look at that reward risk ratio still. You can just that red region versus the height of that green region. That's got to be
Yep.
at least like a 4-to-1, maybe 3-to-1.
Close. It's like three and a half.
Yeah.
About 3.5 to
So
1. Yep.
even with the spread that wide, you can still get a 3-to-1. But we're not looking to hit that 3-to-1.
hmm
And as I said, I'm going to look for somewhere between 100 and 150%, maybe 200% on this trade. And so just say uh, either I'm going to hold until I get to that 100%. It doesn't matter where the price is and how much time it takes me to get there.
Yep.
Or when I see the Tesla, whatever date it is, when Tesla hits the middle, it actually runs up to 475.
Yep.
I'm out on that day.
Yep.
So we can make a few assumptions here. Just say it takes like 2 weeks to get there. How much time did you put on this trade?
Not very much. I did Friday. So what's the expiration you're
Friday.
looking
Okay,
for? We have earnings on Wednesday after close, so the 22nd. You want to go out to the 31st?
sure. Let's do
Okay.
31st.
Okay. So we'll go out an extra week on this. Same
Yeah,
strikes.
yeah.
Okay. Now it
So
costs less actually.
yeah. So there you go. So you have an even better reward risk
Yeah,
ratio.
there's close to 4-1. Yep.
Yeah. And so just say a week left on the trade. So on the 24th, let's say we actually hit 475.
Let's see. I wish I could make this adjustment where it would show. I want to see like the live. If we go to the 24th, this should be a good idea of where we're at as far as P&L. If we
Right.
hit our 475, we should be up about 1,700 bucks on that trade.
Yeah. And we were
So that's
paying
just over 2 to
in.
1.
Yeah. So
Yeah.
that's so you paid 735-ish to get in.
Yep. Yep.
And so that's a little over 2 to 1. That's your 200% right there.
For
Right.
sure.
And so that's why I'm out. Either I hit my profit target before, or sorry, my underlying target before the expiration, or and if not, then then whatever the price is floating around as I get closer to expiration, it's probably going to be at least 100% usually.
Hmm.
Uh, I love
Would
trading in
would
this way.
that target price of 475, did that come from a delta by chance, or what exactly was that? Where'd you pull 475 from?
475 is so I take it from a gamma line, a gamma exposure.
Okay.
So
Okay. Yeah, that makes sense.
yeah.
How far out for your gamma?
Uh so I'll go if it depends on what I want to trade. So in this case,
Okay.
if I wanted to trade for 2 weeks, then that this would have been it. Yeah.
Okay. I'm looking at the swing.
I don't have
Yeah.
access to my gamma normal
I'll
gamma software
show.
right now.
Yeah, I can see if I don't know if I can jump into yours really quickly, but I know I can pull this up. It should be similar. So here is 475 to
475.
480.
Yep. Yeah.
And this is a swing trade, so this is out about 2 to 4 weeks on option flow.
There you go.
So
Yeah.
yeah, I mean that's a great spot, and certainly looks a lot better as far as being long versus being short as far as where the option flows are coming. That is a pretty legitimate spot to grab. And I mean that was offering 4-1 if you're getting it through expiration. Just and again, what you have to remember on the butterflies is this profit trap is at expiration. What is the magical thing about butterflies is like 80 to 90% of this profit trap is done the day of expiration.
Yeah.
But if you hit that prop, like Kane said, if he's able to, target that gamma level at 475, and this takes 3, 4, 5 days, you're still going to see some profit on that trade. What is
Yeah.
dangerous is if you hit this 475 and then you're like, well, I'm only seeing, I mean, if we hit this trade, let's say the options the 22nd, let's go to the 23rd. You're seeing that I'm shrinking this level, or the because it's going to
Yep.
be the 22nd close. So the 23rd, and if we wake up in the morning on the 23rd and it's trading right at Kane's gamma level at 475, we should see some really nice profit on that trade. But it's amazing how greedy traders will get and say like, well, if it's profit trap, like I'm going to hold, but don't. Like if you have a reward to risk that is greater on your butterfly spreads, I think you should take those trades, because so many strategies and options are built around lower reward and higher risk in order to
Yeah.
achieve those higher probabilities. So what Kane has given you is a strategy that is higher reward than risk with also a pretty high strike rate. And that combination is, I mean, I know you can't really say like this is a holy grail of trading, but you can say mathematically that is exactly what you want. If you can win 75 or 80% of your trades with a reward to risk that is greater than 1 to 1, it is very, very difficult mathematically to lose money. So
Yep.
I think, for those of you that are interested in this, like, pay close attention, take some notes, ask for this recording, and follow some of the stuff that Kane is talking about, because this is one of the only strategies that offers big reward, small risk, that you don't always have to manage this all the way to expiration. And it
Right.
makes it an amazing combination where, I think what gets people confused on the butterfly spreads is the fact that it's, wait, how many contracts am I in? This, even though it says buy one, sell two, buy one, you treat this as one trade. All this is, it's just one combination. And if
Yeah.
price is somewhere around this pin price, we should have some profit to show for it. Okay. And there's obviously a lot of profit that's potentially available, but that is like the day of expiration. If I went, I'm trying to think if I can go all the way back here to, we took the trade today,
Okay. Yeah.
right? If for some reason, like today at the close, in the next hour and 10 minutes, if Tesla has, Elon Musk announces that his Optimus is, whatever, he's put in his own house and it's building whatever. It's the news just breaks and it's something crazy. Even if the price was hit today and Kane is all of a sudden in this trade for a 740 debit and it hits his pin, and look, it's anywhere in here. If we had a run up to like, I guess it'd be like 455. If we run up $10,
Right.
Kane's up over 100% on the trade,
Yep.
like, and he could do this immediately. So if you take these trades, how do you like to track these, Kane? Do you like draw on your charts at all? Like when I take a butterfly spread, I usually like to do something like this, where I will, let me do Tesla here. So if I did Tesla and we put in that trade, the first thing I would do is come to my pin price at 475. I'm just going to draw this box and start at the 475, draw the box here. Oops, that's not very good, but draw the box. Ugh. Click on it. And now we'll go coordinates. We had the 475 as the middle, so a 510 on the upside and a 430 or 440 on the downside there. Okay, so if I just mark the middle of this, 475, if price is, this is just what I would do to kind of, in my head, this is what I'm watching for price. I know that it's difficult to make money on the butterfly spread if price is down. If it blows through this, well, there's still a lot of ways to do this trade over the course of a couple of weeks. If it blows through the far side of the trade, it could still fade back down and get into your profit trap. So as Kane said, pay attention to that 475. If you're within, I'd say 470 to 480 and price is hitting
Yep.
that, that to me is like, that's the pitch. If that pitch is in the strike zone, take some profit on that thing, because you're probably going to be close to 100% or better on that trade.
That's right. Yeah. And that's why I was saying earlier, it's 125 to 200% is generally what I see when
Yep.
that happens. It just depends on how quickly it got there,
Yeah,
and versus how much time is left on that butterfly. So Sean is asking, is that pin price exponentially important to get right, or are you saying this has lots of flexibility? It has a lot of flexibility. So
yeah,
what we're saying is there's a very wide region of profit, and you don't have to pit if you're not going to hold to expiration, which is what both Chris and I are saying. Don't hold all the way to expiration.
right.
You're not trying to pin this at expiration. What we're doing is we're creating a hugely wide profit zone so that it is easy for you to profit, and
Yep,
with a high reward risk ratio. So low relative to what you might lose, it's going to be a lot less than what you could win.
for sure. And and also too, it's like I'm trying to show. So if you can follow this line, I'm just going to kind of trace it. If you can follow this line as well. So on the
Mhm.
20th, we don't really take on full risk for a while. We're very, very wide
Right.
on our full risk, and we're very, very wide out here. So like I said, we could have earnings on Wednesday and price just blows through this. We're still not going to take on full risk. Like price would have to be up to, like Kane's butterfly spot is a 505, right? Or 510, 510.
510. Yep.
510. If price jumps up to 510, we're pretty much break even on that trade if it happens within a couple of days,
That's
right?
right.
And we could
Yeah.
even go up to 520 and 530 and still not be risking the full debit that we paid.
That's right.
So so again, on both sides of the trade, it's like you have a lot of time to risk, you have a lot of time to manage profit, and obviously the profit potential is way greater. Which the one thing, like I go back to the butterfly spread, is it's nice to have a strategy where your job is to manage the profit side, because risk for
Yeah,
the most part is managed. It's usually debit or butterfly spreads are very straightforward risk, because the most I can lose is this right here. And even within that, it's rare, unless you're going to hold that expiration, it's rare that you're going to lose this full amount.
correct.
So
Yeah.
that's a good thing. Yeah.
So 007 is asking, can you plan on create a program like this for members? I would love to create a program for this like this for members.
Yeah.
I yeah, I could definitely do it if there's interest in it. Previously, when we were talking with the publishers, like, oh, butterflies, people are, too complicated, but I don't think so. So
I don't think so either.
you guys
Honestly,
like
look,
it, yeah.
if you can look, I do butterflies in my double up service. I'll say, like, if Kane builds something like this, I know that I'm assuming he's not doing like 0 and 1 day expirations like I am. So my double up is very much like SPY, Qs, SPX, 0 to 1 day expirations, and that gives me. And the reason why is because that is what the big profit traps are, where I can take a trade for, a 40-cent debit, and that trade literally at the same day could be trading for like $2 to $3 credit. I'm risking $40, and later in that day I could be up $300. Like that is literally possible in like a 0 to 1 day expiration. But I
Yep.
follow those gamma levels very closely. I use it on SPY and Qs and SPX primarily. But to go out like Kane has shown us there with a huge window of like $30, $40, it's amazing, man. Like that's so much forgiveness to have. And I teach the butterfly, like it's like you're casting a net into the market that allows you to scoop up some profit with a pretty high probability, because
That's
the
right.
odds
Yeah.
are price is going to move and somehow land itself in that net. It's just a matter of how you want to manage the winning side of the trade. Making 25% return on risk or 50% return on risk in a butterfly spread is fairly straightforward. And I'd say like a high probability. But what's even better is when you can land those like 100 plus winners and still get a, 60, 70, 80% win rate. That's when you're talking mathematically like a brilliant strategy. Just doing the math on win more than you lose, win a lot bigger than you lose. Like that combination is amazing for traders.
That's right. Yeah. And Sean's asking if this will work when IV is not so big, or you try not to capture this high IV. No, it works absolutely when IV is not that high either. What happens is if you happen to catch a high IV, your reward risk ratio is just even better. And
Mm-hmm.
as that IV crushes, then it pushes your risk graph closer to the expiration risk graph. And so you see it get squeezed to that expiration risk graph a little bit sooner. But either way, it's a great way to trade, even if IV is low. And that's why I was saying the butterfly is a great way to trade regardless of your the market environment, because you can always tweak it to make a great reward risk ratio trade. That's the number one
Right.
feature there, is that reward risk ratio.
Yep. I'm going to show one trade that I built out. I'm taking a little chance. I've been a little frustrated by daily profit play. I'm really cautious right now daily profit play wise, just because the premiums are not great unless you're going really tight to the expected move. And I swear
Mhm.
that the plus minus of 30 points or 40 points has not been what you're seeing intraday. Like you're getting 50, 60 point moves, 100 point moves, and maybe by the end of the day the market is settled, but it just it's a lot of like day-to-day stress when you're like, yeah, I'll sell 30 points wide and the market's up 60 or 70 points. You're like, it's never going to come back to get me profitable, and then it does. It's just more stress. So anyway, I put this trade on just now. It's not official, like it's not a service trade or anything, but I'm trying to take advantage of a little bit of this crazy volatility this week. We do have some earnings. The market's clearly back in positive gamma environments. If we're going to retest the highs at 67, 65, maybe we find a way to stretch up to like 6,800 this week. I talked about that broadening pattern. So if you can see the top right-hand corner, I'm just going to build this trade out on my risk graph and just show you what it looks like. I'm going 68.15 on the call side and then 66.55 on the put side. I'm essentially doing a calendar spread. And this is not to like make anything confusing. I'm just going to show what it looks like. So these are all puts. And let's see, 27, 28. This should be good here. And then I sell and I buy. Okay, let's see what this looks like. Okay. This is a trade that I took this week on SPX. So if this goes all the way to expiration, so let's say that I took this trade today, the 20th. Um, if price doesn't move tomorrow, I'm probably going to see a small profit. Okay. If price starts to move, I have a couple of trapped opportunities. So what I did is I went out and I, bought the Tuesday calls. I sold the Monday calls, and I basically pinned 68.15. And that's why I was asking Kane about the deltas, because right here, this is a 25 delta. This is a 25 delta call side. This is a 25 delta put side. And I'm pretty much right in the middle. So I could see price doing this where we have some elevation to the upside or to the downside. If we're going to stay positive gamma, I would say the market probably revisits highs. If I get on this trade, I paid about, this is about right, $6.80. If I can pull in on this trade, now there's a profit trap potential, but it gets a little dicey if we're sitting around the current price. I need volatility. This type of trade is a volatility expansion type move. Like, I want to see the SPX actually go up 1 or 2%. I want to see it go down 1 or 2%, and then I get paid pretty nicely. So very similar to what Kane said on the butterfly spreads. If I find myself this week in price action that we're talking SPX at 68.15 or SPX down to 66.50, I'm going to take profit. Even though it may not be my full profit trap here, it might only be, of the 680 that I spent on the trade, this might be like $100. This might be $100. I'll still take the profit because it's at the levels I think are reachable. 25 deltas are reachable if the market's going to stretch to those highs and lows, but I doubt it's going to stay there just because market makers are kind of constantly providing those, daily and weekly guardrails, and they make adjustments. So anyway, it's a trade that I took on. I'll watch it. I've already got the debit. So I put the debit in it was 680 was my fill. I'm going after a 780 credit. So I'm just trying to make $100 on it. I'll obviously watch it closely. Like, if it hits my pin price, I'm going to be up maybe 150 to $200. But if I can automatically close it, the nice thing too is if I'm right, the broker can automatically close me out at that first available price. So if we gap up into that area, this might be worth $9 or $10, and the broker can, it can't fill me at 780. It's going to have to fill me at, $8.50 or $9 maybe. So we'll see. But all sorts of ways to take a crack at the market. This is one of my favorite ways to do like volatility expansion plays, because I think the market has, I don't know, man. It's just weird, dude. Like this week was it was an odd Monday. Obviously, I've got a nice jump in P&L. The market's back to positive gamma. All the stuff looks promising, but I can't help but wonder where we're going to be as the government comes back online, as we officially start to get some data coming back in, like CPI. CPI is forecasted to be higher at 3.1%. I don't think the market really cares. Kane, I want to ask you one question on some bond yields or some treasuries. If we talk US 10-year, okay, the one thing that I am concerned about is back here in September 2024, the Fed started cutting rates, and they cut 100 basis points. Okay, September and October and December, we are going to see another 25, another 25, and another 25. So my question to you, Kane, is if the Fed from September 2024 to December 2025 has cut 1.75% from the short end of the curve, is this a problem if the long end doesn't change? Or worse yet, if the long end stays elevated? Does that make sense?
That's a huge problem.
That's what I thought. Like that, and that's my biggest concern with like what happened with Tricolor, what happened to First Brands, what's kind of happening on the surface of like private equity right now. And the regional banks had some blowout last week.
Yeah.
If all of a sudden investors realize that we are not going to see better borrowing rates, even though the Fed has cut a crazy amount from the short end of the curve, if we can't borrow cheaper, this is going to, I feel like investors that have been waiting for rates to fall, waiting to refi, they might not get the window. And this did scare me. I listened to a podcast last week, and I think it was actually like Tom McClellan, like the famous like McClellan oscillators and his whole family that's been in the markets for forever. But he was talking about the long end of the curve going, right back up to like 4.2, 4.3, 4.4. And if it's all of a sudden this reality that like, oh my gosh, rates are going to go back up. Oh my gosh, like buying a car, like student loan, anything. buying a house. If none of this is improving, then I think that has like credit implications for the overall markets. And
Yeah.
the bond market is smart. Everyone says that the government will keep spending money until the bond market takes away the keys. And this is a concern of mine going into like 2026, man. So I want to get your opinion on that.
Yeah, so what's going to happen if what Chris is talking about is that basically at some point in time, what's going to be evident is that the Fed has no control over the bond rates, right?
Right.
So we have this illusion that the Fed is controlling the bond rates, but in reality, it's the market, right? The market currently is taking cues from the Fed and has been for many, many years, taking cues from the Fed in order to trade and adjust what the rates on the yield or what the yields are going to be. But if we start to decouple and we see that no matter what the Fed does, the what traders are just going to put rates wherever they think it should be, then we're going to eliminate that illusion that the Fed controls rates. And what will have to happen at that point in time is that we're going to eventually pick a new risk-free rate in the market. It's no longer going to be U.S. Treasury.
Right.
And there's argument that, hey, now we're double A, double A, double A. It shouldn't be the risk-free rate anymore.
Right.
So it's only a matter of time before this type of thing happens. And once you have a risk-free rate being redefined, that's a reevaluation of absolutely every single asset in the market. And
Yep.
that's going to be a very volatile time period.
For sure. And I do wonder in the background is like, is that what the market is trying to push towards with this huge surge in gold? I mean, here's a couple of staggering numbers. If we were to put the market back at fair value, like the S&P back at fair value, we're talking like a 4,200 SPX.
Mhm.
If we put the fudge, I'm trying to think. It was definitely S&P 500 is one, and well, I know right now that the Fed is refinancing around like 3.3%. There's nobody in the world right now that is borrowing or refinancing at 3.3%. Nobody.
Yeah. No.
So how are they getting that? And how is this being extended? I mean, there's either a crazy amount of creative accounting going on, or it's just the Fed has this window where we're just doing everything we can to reduce the short end of the curve because that's all. I mean, think about this. If you are financing $37 trillion in debt with
Yeah.
short-term windows, like you're talking like, hey, this is a 3-month refi, this is a 6-month refi, this like no more than like 1 or 2 years out, you that's insane that you'd have to go that short term and you're gonna have everyone step in line to do the same thing. Hey, don't worry about the 10, 15, 20 years out. Like we'll do like 1 year or less.
No.
It's just so risky, man. It's so, and I don't know. And I'm not
Hugely.
I'm not saying that to be like doom and gloom. It's just these are, nobody liked this trade last in 2024. When this happened, this was a shocking move where okay, finally we get some relief. The Fed's going to cut rates. 40 plus years of trends show us that when the Fed cuts rates, the 10-year will follow. It didn't, and it did the exact opposite. And then we had our Liberation Day blowout. This is when the basic trade and all the term premium stuff was all wacky. And the 10-year has been coming lower, which has been good. But like I said, my concern is we're right back here nearing that 2024 period, and we already cut by 25 basis points. It just started to get lower. If we cut at the end of October, and I'm just thinking seasonality wise, this market might continue to tolerate maybe a slightly lower 10-year. But if we cut in December and all of a sudden this spikes, I think that's a huge red flag for 2026.
Oh,
I
yeah.
think.
Yeah.
So I think this is something you need to keep an eye on as far as like just where risk can come from, because of the underlying stuff in the private equity market is looking like this is who said it was a JP Morgan, was it Jamie Dimon last week that said there's some cockroaches in private equity, which means if
Yeah.
if there if you see one cockroach, there's more. And so Tricolor, Tricolor, and First Brands, like
Yeah.
it's and again, it's only $4 billion versus $500 billion, so it's not quite a 2008 red flag, but it has been. I mean, when you see like Stanford's endowments and Yale's endowments, like all these like we're talking 5, $10 billion endowments for universities that they're basically dumping, their private equity holdings into
Yeah.
whoever wants to take it. I mean, I think didn't Howard Marks and Oaktree, didn't they sell off some private equity this last month or so? I don't know.
I don't remember who, but yeah. But for sure, this private equity thing has gotten me pretty nervous
Yeah,
because the the majority is like 5 or 6 firms. It's like Blackstone and
and
a few
is it like
others.
Blackstone, Apollo, and some of those big names?
Yep,
Yeah.
yeah, exactly.
Yep.
And so, and they've gotten so big. The whole point of private equity and allowing it to grow was that it was this idea that if they blow up, it doesn't affect the banking system.
Right.
And what's happened is that the main players, they've gotten so big that they're actually taking leverage from banks. They're getting financed by banks.
Yeah.
So they have become this sort of, too big to fail situation like we had in 2007, 2008. And if there is some sort of event that takes down these private equity firms, and what would that event be? It would be the fact that they're taking on and leveraging using something that is the equivalent of subprime back in the mortgage days, which is
Hmm.
like, oh, you just tell us how much you're making, and then we'll fund and finance you, or I'll buy into your fund or at whatever valuation you tell me. It's like, are you kidding me? Like you're running private equity without verifying numbers, without verifying cash flow or verifying sales. That seems like the most retarded thing that you could possibly do, but it's starting to happen.
Love it.
So
Love. Yeah.
it really is looking a
And
lot like
Arbitrage, the
2007.
movie Arbitrage is pretty much what I'm thinking about right now. It's a movie with Richard Gere. There's like there's a affair in it or whatever, but like put that aside and look at what he did to basically offload his business to
Mhm.
somebody else. He sold a bunch of shit to somebody else and got out scot-free. Like
Yep.
I think that is what would be happening in private equity. And to kind of put this all and make it go full circle is, does everyone remember earlier this year when there's been a motion to try to get private equity and more exposure for retail investors into private equity and give us like the privilege to own private equity and have this exposure? When
Oh my
I
God.
think of that as a contrarian, as they are dumping the stuff that they don't want to
Yeah.
us as retail
Yeah.
traders. So be very, very cautious of that crap, because I think that is a sign of, you want to feed the frothy retail community, feed them all your subprime and feed them all your BS garbage that you don't want in your books anymore, and they'll take it and they'll be left holding the bag, and then the thing can freaking go up in flames, and big corporate America survives and Wall Street survives and retail crowds just get busted up. And you look at, everybody's 401k. If I mean, imagine
Yep.
that just a 401k right now that's just buying a basic targeted fund. You know what you're in? Mag 7. That's pretty much it. You're in Mag 7, because whether it's some ETF or some mix of bonds and equities, you're in freaking Mag 7. That's pretty much, and it's been great. It's been great for 10, 15 years. Okay. But if the market goes sideways or we have a huge implosion, gosh, it's going to be so volatile. And it's like, this is why, and I don't like to give like the bearish community like so much volume, because I feel like if you fan that flame, it shows up everywhere. It's like, this is the end and this is the fourth turning. It takes a long time, folks, for like a bear market to come in and really take control. It takes a long time to like have it do all the damage. I mean, you can see right now, it's like this market refuses and has refused for months and months and months to go down. So I think there's still a lot of technical support here. Statistically, having a good September means higher highs. Getting back in, I mean, we watch this every single day, looking at the markets going into a positive gamma every single day, looking at the stability of zero DT every single day. This has kept the market going. I mean, Kane, I think it was just a couple weeks ago, there was a day of zero DT. It was 73% of the SPX volume in a
Oh,
day.
oh, that's crazy.
It's just insane. Like, I mean, when I first started trading zero DT back in 2022, it was like 35, 40%. We've had it's consistently over 50% now. And we've had days in the 60s and 70s where it's like a majority of your intraday option volume is all zero DT. So it's good and it's bad. Like it's super, super stable. But the big sellouts we had for some reason, October 10th was a like it was like everything zero DT disappeared. It dumped so quickly, like there was no zero DT buying. July 31st and August 1st, same thing. Liberation Day, same thing. Like we've had
Yep.
three kind of blackout windows of zero DT. Everything else has been providing a lot of stability and a lot of like just forced participation in the markets where people are very aggressive at these levels. But again, I want to be optimistic. I'm trying to always be a glass half full. I think if I'm positioning, and this is kind of where I'm at, I think that I would question the integrity of this bull market if we are below 6,000. If we're below 6,000, I would say, okay, we might have a test, a failed dead cat bounce, and then beware of that next leg lower that could start getting us. This is what I'm saying. Like this would be bad. It's not going to fall in a straight line. I don't think. Do you think it'd fall straight down? It shouldn't,
No, no,
right?
no.
It won't be a straight line, more than likely. But a dump here, and then a dead cat bounce, and then a dump here. There's a lot of damage done there, and you certainly know there's a lot of damage done there. If we unravel all of this melt up, it could happen. So this is why, like Kane said earlier, he's not going out very far right now, and I'm not either. I think a lot of my bullishness is positioned in end of the year, December into early January, and a lot of my forgiveness levels is as long as we can stay above 5,800, I'm going to be okay. And everything I have below that is defined risk, but still, this gives the market a lot of time to just be noisy. And one direction that we can also trade, everybody, is down and up and sideways. That is a market. Markets can go up, down, and sideways. There are ways to still make money in these markets. This is confusing for a lot of traders. This is challenging for a lot of traders. Follow Kane with his butterflies. Let's find some creative strategies to benefit from this noise and lack of direction. Because everyone is just kind of complacent, thinking like it has to go up. It has to go up. It's going to go up every single day. And if it goes sideways if we have a government shutdown for 40 plus days and the market is essentially sideways for 40 days, okay, that's a lot of traders going to lose money because you're long options. You're getting smoked on time decay.
Yep.
So anyway, up, down, sideways, folks. Like we haven't had anything sideways. This is the last time we had sideways, and it led to a correction. This is the first time. I wouldn't even say this isn't even technically sideways yet, but we'll find out more this week, right? Because if we get into this week with CPI data, if we come out of the government shutdown and we're still sideways, I think that little broadening pattern, maybe we have that blow off top at the very, very end. Maybe. We'll see. I think we still have to have some risk appetite, risk on versus risk off. But what do you think, Kane, as far as technicals? If we're above 6,000, you still like this market?
That'd be a little generous. I'd be worried a little bit sooner than that.
Okay.
Um,
6,150, 6,200?
yeah,
Okay.
yeah, I think
200 moving
November. Yeah.
average. Yeah, the 200
Mhm.
moving average is around 6,154 right now. The 10-month moving average, which I like to use for, if we're below the 10-month moving average, I'm typically just going to straight cash or selling a ton of premium because the VIX is generally higher. But between my 200-day moving average and my 10-month moving average, that's a 10-period monthly. That's right around 6,150 or so. So I'm saying 6,000, but if we're even testing 6,000, I'm not liking this. I'm very nervous. But if we're back
Yeah.
down to 63, this is a measure move from the sell off here that gets us down to about 63.30. There's levels of support right there. So if we hold that, that's a lot. That's the 50-day, the 100-day, the 144 period moving average. Like to me, those are dynamically some pretty good spots to be looking to get long. And it might just offer this, everybody. Maybe maybe we go a little bit higher. Maybe we come back down. That's the broadening pattern I'm seeing. Like look for that stuff, but I'm not getting super bullish outside of maybe a retest of the highs. I'd be very cautious because one thing that has happened in the stock market is the market V bottoms, but it also rounds the tops. So this might take a while, but if it starts to roll over, you don't want to be left being a bag holder at a bigger structural move. And that's a huge question mark, but we'll know as obviously we'll get more price discovery in the next 30 to 60 days and we'll figure out where this thing wants to go. But taking a long time to stall, if we stall for more than 20, 30 days, I start to get a little nervous because usually markets, when they stall out, they tend to want to roll over. And I don't like
Yeah.
that very much. So just be cautious
Yeah.
of that.
That MA 200 is an excellent place to look. So, 6,000 is where the MA 200 is right now. But,
Okay.
give it another 2, 3 weeks.
Yeah.
That's
Yeah.
what I'm looking at. It might be at
Yep.
like 6,200.
Yeah, very true. And yeah, so as price, if we go a little bit higher in price, this goes up, this goes up, this goes up, this goes up, and yeah, we could be sitting. This is 6145, so I think between like 6100, 6200, that should be kind of the line in the sand for the Bulls to step in to defend a lot of things.
Yep.
So, all right, final question for you today, Kane. Um, do you think that the U.S. is going to win the AI race? I know that's a futuristic question, but
Ooh.
do you think? Let's say in the next, it's 2025, dude. So let's go out to 2030. Has the
Yeah,
U.S. won the race in AI?
I don't think so. I don't think so.
Who's winning, or what do you think that landscape looks like? Is this, everyone gets behind the winner of AI? Are we
No.
still dilly dallying in this, like, tit for tat trade war stuff?
Here's what
It's so
I,
uncertain, man. I don't know. It's a lot
here's
of
what I
capex
think.
spending. That's what I'm saying.
So here's the thing. I don't think the AI race is won yet by 2030, but
Yeah,
we'll definitely see a much clearer divide between the contenders. The reason why I'm not super optimistic about the US is because where are all the PhDs going? They're not
yeah,
going to America or US citizens. They're going
yeah,
to people coming over from India, from China, from
yep,
these other countries coming
yep,
in on H-1B visas, and we just keep making it harder and harder for that to happen.
yep.
Then a lot fewer of them are wanting to stay in the U.S. afterwards. There are a
Right.
lot of them going back to their original country. It used to be that H-1B visa, they would come over and then they would get a job in the U.S. and they would stay, put down roots in the U.S. And that
Hmm.
just really hasn't happened in the past like 5, 10 years. So
Right.
it's hard to see that changing and for the US to actually keep up.
Yeah. Um, do you think in saying that, does that make the non-US performance more attractive to you? Like doing an international, like this is something I just closed this out. Like I said, I'm raising some cash right now, but I closed out SCHY, which is a mix of Europe and China, and
Mhm.
India. So there's a little bit of both, but it's mostly all non-US. So 60% Europe. So do you want to know what the best country ETF is this year? Do you know what it is, Kane?
I do not know.
Greece.
Seriously.
Yeah.
Wow.
Like the
That's a
pigs.
surprise. That's a
Yeah.
surprise.
Portugal, Italy, Greece, Spain. They are like some of the best performing ETFs this year. Greece was up like 60, like 62% year to date.
Wow.
So fifth, this is about 60% exposure in Europe, 17 and change in Asia, 12%, abroad. So, North America has some exposure. This is Canada, Mexico, but this is a non-US and it's also pretty cheap. So I
Yeah.
did some, I did some dip buying in here. I started to participate late 2024. I didn't really add more to it. I mean, to me, this wasn't like I'm all in on international. I just wanted to see if the market would recover. So a lot of my profits in 2025 were the courageous, participating in March and April's decline, and I benefited from this melt up, April through now. But as I bought, non-US, it's like we're sitting up here near the highs. I do think this has good potential. But the one thing that makes me nervous is like the U.S. will drag everybody down with it. Like if the U.S. tumbles or stumbles and we hit some hiccups along the way, it's tough to see like everything go higher without the U.S. being like this stable backing for that. I could see
Right.
outperformance by other things. But if the US is down, 10, 15, 20% all by itself, it's going to drag things down with it. So I
Yeah.
think, just like we started in Liberation Day, if everyone thinks like, well, I'll just be in, India or Brazil. I mean, look, I've got all these exposures. I'm in Brazil. I'm in Latin America. I'm in some non-US stuff. But if the US goes down, it's going to drag everybody with it.
Yeah,
We saw
here's
it.
what I'll say. Like, even though I'm not super optimistic about the US winning the AI race, but
Mm,
people love to invest in the US, and there's
yeah,
various reasons why. And maybe some of those conditions don't continue to hold, like it's the biggest financial market and blah blah
right,
blah.
right,
But what what will hold and will continue to hold is that the American financial markets, American companies, they put earnings first. They put making
for
money
sure.
first, which is
Yep,
not the case for most of the rest of the world. And
yep.
people aren't just driven to make profit in the rest of the world. Better work-life balance, whatever it is.
Hmm.
Part of that culturally is not, hey, these I'm not going to put making money first. For example, how come China's stock market has done squat in the last 10 years? They're the
Yep.
second biggest economy and they have amazing companies. How come their stock market isn't performing like that? It's because they don't put earnings first. A CEO is not incentivized to maximize shareholder value. They're just
Right.
not. They don't care
Right.
about that. And so the American culture is, hey, let's make these profits, let's make our stock go up. And that's
Yep.
why people love investing in the US.
Sure. Yeah. And, and they've done it obviously with the ability to have a lot of leverage. But anyway, I think we're looking out a little bit further in the lens than we need to. But I just think this is all stuff where if we've got a radar, these are things that have to be blips on the radar because I'm watching the bond stuff. I'm watching the US Treasuries. I'm very curious how the end of the year comes in. We've had two failed Santa rallies in 2023 and 2024, technically from
Yep.
Christmas Eve to New Year's Day. Those were two negative windows of stocks. So if the market limps in to the end of the year and we don't have a meaningful correction now, I think that, probably this like mid-January to mid-April to me looks very vulnerable for the stock market, at least having some type of cleanse. If we maintain this current, like just buy the dip, buy the dip, buy the dip, and the most we get is like a 3% flush. Just be cautious of like where we get to all-time highs. Maybe we do hit 7,000 by the end of the year in the S&P. But if we do that, I'm a little more cautious going into 2026, at least initially.
For sure. For
So
sure.
all right, Kane. Any final thoughts for Say Man? Dude, I appreciate the butterfly spread. You have opened my eyes to wanting to look a lot further out than I do. I'm usually out like 0 to 1 day. So going out, 20, 30 days. In fact, you might actually change the way that I trade some of my earnings plays. We just did newsbreakers today, and I'm
Mhm.
putting in some trades based on my earnings probabilities. But man, to have that nice net cast out over like a 5 to 10 day window with minimum
Yep.
risk, I think that's freaking sweet. I like that a lot.
I love butterflies around earnings, especially, double butterfly. You can do one above and below around the
Exactly.
expected move.
Yep.
It's a great strategy.
Exactly. Like Tesla's a good example because Tesla has earnings Wednesday at close, and you could do a Friday expiration. And granted, Friday's kind of like an all or nothing. But if we hit the expected moves, it's like I would calculate out. Here's my Tesla going to the stock. I think we're due for like a 10 to 11% move on average. 11.84 is the average over like the last 30, 40 earnings prints. So if I'll round it to 12%. Tesla's trading for 446. So if I went up about $50 as far as my pin price, and like Kane constructed today, it's like doing like a 20, 30 wide, cast a 30 wide net, cast a 30 wide net. Actually no, is I mean, you got a 70 wide net. If you went like
Yeah,
30 wide, 30,
170.
you got 60 or 70 points wide. Like that's awesome. Yeah, I just kind of want to look at that. If we're up, let's just say $50. Okay, so Kane he's got to 475. You talked about the 475. I like this as, let me see the deltas on that. If we go Tesla, I'm just
There's a
curious.
great gamma pocket at 500 also. So that
Very,
I've
that's
got a trade on
even,
targeting. Yeah.
and that would be very cheap too. Like that butterfly would probably offer, I don't even know. You could go pretty wide on that one and probably still get 5 to 1 or better if you're going that far out of the money, I would think.
Yep. Mhm.
Let's go to the 24th. So it's a big move. I think maybe safer would be like the 31st, so it's not like all or nothing. But if you want that profit trap, this, let's go up to, let's see if we can do like right here. Here's an easy way to think about it. Use the broker platform. This is my Tasty Trade platform. Can everybody see this as the expected move? So this is showing about a $32 plus or minus at current price based on, even with the earnings coming out on Wednesday, the broker says, you know what, high side about 32 and change, which puts us up to about 477 to 480. Let me pin that level. Let's see how much this costs us to get up to about that 480 strike. So if we did 480 and let's go 25 wide. So go to 505 and then 455 there. So it cost me $4 to potentially make $2,000. And all price has to do is basically, move up a little bit. Like this is the expected move, percentage wise. The price of earnings. I mean, what's nice is we could still go to my calculated move, which is about $50, and we'd still be inside the profit trap.
Yep.
So I mean, this is my, trying to draw this out if it will let me. Here we go. So my 480 is my middle price. So this is my risk is here. I have my debit of 397. I have my profit trap and I have my risk at 397. So this would be if price is less than 455. This is by expiration, and this would be above 505. So above 505. So we have a 50 wide net. This perfect price is around 480. And if price is, moving a little bit higher or moving way through my earnings calculation, we're still in, anywhere in here is able to offer up. Like, it may not be realized to the true like max profit, but even if you get price around that like 470 to 490 zone, you're going to see some profit in that trade well before expiration, which I think is awesome. So if you took it both ways, here's what you need. If you're going to lose 100% on one, you just have to make more than 100% on the other. So if I win, 150 and I lose 100, I walk away 50% return on risk, and I can trade the market both ways. So is there a way to lose? Yeah, price goes absolutely nowhere, and you end up losing on both sides of the trade. That's the worst case scenario. But as long as that risk is manageable for you, earnings is usually not a nothing burger. It's an excuse for the market to move. So
That's right. Yeah.
Anyway, good stuff, man. A lot of fun today, Kane. What do you want to do next week? Think about it. We'll come back and let's get some feedback in the chat before we go. What do you think of today's session? Pretty good stuff. So last week, collar trade discussion. Today, deep dive into butterflies. I know I got a little like longer term on the bond stuff. This is just, these some content pieces I've been reading the last couple of weeks, and I value Kane's opinion, so I wanted to shoot that around with him. But hopefully, good feedback. Everyone's coming in, enjoying it. So next week, I'm also happy like diving into some other strategies. Traders are also welcome to post like, could you guys break this strategy down? And I think what'd be fun next week, Kane, is let's take a strategy and let's both kind of, do like pros and cons. And sure. Like, let's do like a user-based strategy that's like, give us one that you like. It could be, credit spreads, even best practices on like buying calls or buying puts and a spread of some sort. And Kane and I can kind of tag team and go back and forth on what we'd like to do with it. I think that'd be fun for next week.
Sounds good. And we also got a couple suggestions here. We got double butterflies, broken wing butterflies. Okay. People are enjoying it. Yeah.
Very good. Yeah, Kane, I'll kick it around. Broken wings. I love me some broken wings. So if Kane wants to dive into that, I wouldn't mind sprinkling some broken wings next week. But anyway, let's keep talking, keep showing up, spread the word. We'll be here for the Gam Report next week. But thanks for tuning in. And Kane, thanks. Good stuff, man. Where you at, by the way, in the hotel? Where you at?
Yeah, I'm in Switzerland right now.
Oh, what time is it there for you?
It is. Oh, that's a good question. It's like
8, 9 p.m.
9 something, 10 something.
Okay.
Yeah, 30 maybe.
All right. Well, you going skiing? What are you doing out there?
No, I had a little work to do over the weekend and met some people out here, getting my ducks lined up in terms of viewpoints and overall like there's a fund out here that was asking some questions, and I just flew out just to meet him.
Sounds promising.
Yeah. So.
Cool, man. Well, yeah, good luck with that stuff. Let's talk soon. All right, everybody. We'll see you next week. Thanks, Kane.
All right. See you. Thanks. Bye everyone.